Greetings everyone and welcome to lesson 14. Today we are going to talk about three candle patterns. Now in the last two lessons, that is lesson 12 and lesson 13, we spoke about one candle pattern and two candle pattern respectively. If you haven't seen those videos, I would encourage you to go and see them first and then come back here. However, if you have already seen those videos, then today we are going to talk about three candle pattern, and basically we are going to talk about two important patterns called as Morningstar and Eveningstar. Now, three candle patterns are more effective than two candle patterns or one candle pattern because we have three candles or more time frame for a pattern to form. Now when we talk about one candle pattern, we only have one candle or a limited time frame to take action. In two candles, we have a slightly higher time to react. However, in three candles, we complete the cycle, or basically we understand where the bulls or bears are heading towards, and that is why three candles in my view are comparatively stronger signals than two candle pattern or one candle pattern. Let's start with Morningstar. So Morningstar is basically a bullish reversal pattern formed by a negative long candle, and the second candle is a candle with a small body that gaps below the first real body to form a star, and the third positive candle closes well into the first session's real body. Let us try to understand what we mean by Morningstar. So basically, first we have a really long negative candle. Post that, we have a gap down, and the second candle will be having a small body. Remember, the second candle should have a small body. The color doesn't matter. Second candle can be positive or negative. It doesn't matter. It can be a green candle or a red candle. The only thing that is important is that it should have a small body and it should have a considerable gap down. That means next day's open should be well below first day's close. After this second candle, we want a third candle which is positive and which is well above the half of the first candle. Now let me explain you what this actually means. For example, we have a first negative candle, so let me mark open and close, high and low. The second candle will be a green candle opening much below this close, somewhere say here. Now color of this candle doesn't matter. It can be a green color or red color. Basically it can be a positive candle or negative candle. Now the third candle, however, has to be a positive candle which closes in the half of the body. So let us say the first candle body, this is the body of the first candle. Now at least it should close above the half of the first candle. Now if let us say open was at 100 rupees, close was at 90 rupees, so half is at 95. So the third candle should go well above 95. Only then we say that Morningstar pattern is complete. Now this is a trend reversal pattern. So whenever there is a downtrend, then we have a negative candle, then a gap down and the positive candle. Whenever we see this pattern, this indicates that bears are exhausted and bulls are trying to come into the rally, and from here we can expect the market to shoot up. So this is basically indicating that a new morning or a fresh morning would start, or fresh bullish run would start. New rise would come in the market, which is why we name it as Morningstar. Let us see some examples. So here you can see in this downtrend, we saw a red candle followed by a gap down with a small body, and then we had a positive candle, a perfect setup of Morningstar, post which trend reversed and market went up. Similarly, the opposite of this pattern is called as Eveningstar. Now in Eveningstar, we first have a positive candle, then a gap up, Now again, the body of the second candle doesn't matter, it can be positive or negative. What is important is that it should have a gap up. Gap up means the opening of today's candle should be much higher than the closing of previous candle. Then the third candle should be negative and closing well inside the first candle. Now this is the pattern that is exactly opposite to Morningstar, and hence indicates bears are coming into the picture, or evening is about to set, or basically a fall is expected in the market. Let us again understand this pattern. First we have a first green candle or a positive candle, a strong positive candle, where this is, let us say, open, close, high and low. So after the close well above first candle's close, the next candle's open would start and the body would be small. The color of the body doesn't matter, it should be a small body, and then post which the third candle would be negative and will close well below the half of the first candle. It will close well below the half of the first candle. Now it is a trend reversal, so whenever market is going up and when you see this pattern, it basically tells you that the market is going to fall down and basically a bearish rally is about to start. Let us understand this setup also with an example. So here you can see that in a positive rally we see a first major green candle, then a gap up, a small candle, then the third candle which is well below the half of the first candle, indicating that this bullish rally is about to exhaust, and post which we saw a nice little bearish fall. So three candle patterns are quite effective in Indian market. You will see a lot of three candle patterns if you observe the chart carefully, and they have amazing risk reward ratio. You can definitely try it out and let us know in the comment section about your experience. So this was it about candlesticks. We started discussing with one candle, then we saw two candle pattern, then finally we saw three candle patterns. However, in the market there are a lot of other candlestick patterns. We definitely cannot discuss all of them. However, we have discussed most important ones. So that's it. We'll sum up the candlestick classes here. In the next lesson, we are going to talk about technical indicators. Now, in the next lesson, that is in lesson 15, we are going to talk about one of the most basic and famous indicator called moving average. We are going to talk about what is moving average. Then we are going to talk about two different type of moving average. First, SMA or simple moving average, then EMA or exponential moving average. We are going to discuss in detail about the difference between EMA and SMA and understand which one is better. Then we are going to talk about how to generate entry and exit signal using the trading setup, and then finally we'll work about optimization or improving accuracy using EMA setup. So all of this we are going to talk about in our next upcoming lessons. So thank you so much for watching this video. Spread knowledge cause it's free, and if you like our video, do like, subscribe, share and comment your reactions to our video. Thank you so much, and I'll see you in the next lesson.